Introducing our new series of intimate in-person trading conferences in some of the greatest cities in America. It's Market Rebellion Live. Next up, this June in Sonoma County, California. Savor some of the finest wines in America while you level up your trading with Pete Najarian, John Najarian, AJ Monty, Ryan Mastro, and Bill Johnson. Sonoma is limited to just 25 seats to ensure every guest gets personal attention, so act now. Tickets are going fast.
Hey, good afternoon once again, Market Rebels, and to all of our YouTube traders out there. Yes, I'm in a different room. I've had a couple of special webinars I've had to run, so the equipment was all set up here. So it looks a little different, but it's still the same show. And of course, we all know Stu. Stu, markets kind of flat today, weren't we?
Markets were flat, relatively flat, less than 0.5%. Nothing
Major. But we wanted to talk today what we think is one of the most important perceptions that you can have as an options trader. And Stu and I both agreed. We said, this is one of the biggest traps that people fall into. And it's really what we like.
Perception is reality. You know that.
It is. It's what we like to share with you on Coach's Corner. It's not so much about the things you can get everywhere for free and what's a vertical spread and all that kind of good stuff. We want to show you the perceptions of professional traders and market makers. So as always, let's kick off, Stu, with a little
chalk talk.
And today, hopefully, this is going to be an easy question. So here's the thing. I'm going to make you an offer you can't refuse.
I love that.
So we're at a horse race here. And you have one of two choices. You can place your bets now before the horses have taken off. That's choice one.
Okay.
Or, drum roll, please. Choice number two, you can place the exact bets after the horses are halfway around the track.
Same bet.
Okay.
Would
you have an advantage? Which one would you take and why?
Well, I already know my answer, but go ahead.
Stu knows his answer. I have a feeling that everybody knows their answers as well. Yeah. And we wanted to make this what seemed to be pretty obvious.
Yeah.
But we're going to show you that this exact situation, when we put it in terms of options, people do exactly the opposite. Yep. So it's a whole mind game with the perception. So what is this thing that we're talking about, and how does it affect you as an options trader? And so today we're going to call it the blind side. It's the side that everybody misses. You like that, huh, Stu?
Yeah, just like the movie, The Blind Side.
Very cool movie, by the way.
Protect the quarterback from things that he may not tackle. Yeah.
Things you think that you see, but you don't. So to start off, I'm going to do another little story, Stu. I'm going to put you on the spot here. We're going to take a little trip to a casino. We're going to do some blackjack.
Okay.
So you're on. I'm going to place a bet with you.
Yeah.
The dealer just dealt you some cards, and I want you to guess what the face down card is.
Oh, any card. Pick a card, any card?
Pick a card. Obviously not the queen of spades, but any other card.
4 of diamonds.
You're going to say it's a 4 of diamonds?
Yeah, I'll say it's a 4 of diamonds.
Okay, you're going to go with that? So we flip it over, and it's a 10 of clubs. Bummer, you lost. You lost. So we're just going to walk away, right?
I'm done with my bet. I picked and I lost, so I'm done.
You picked and you lost. This is what you thought was going to happen, and you lost, so we walk away.
You walk away, and we're done. We don't win. We don't lose. That was it. We're done.
Obviously, people should say, hold on a second. Aren't we playing blackjack here? What should we do here now that we've seen the card turned over?
Well, I think that we should play the hand.
Ooh, there's a novel idea. A little bit like the horse race. Now that we've seen how things are unfolding, we have a new choice. And we can say, well, yes, I didn't guess the card correctly. Maybe that was one bet. But now that the cards have been turned over, I now have the opportunity to make another bet.
Unless I walked away.
Unless you walk away.
And then I don't have that opportunity anymore. See, that's your choice as a trader.
Correct. So you're going to find out that we can place this bet, and it's because we have information that we didn't have before. When the card was face down, there was a lot of stuff we didn't know, but now there's a lot of stuff that we do know. And because of that, we can act on the new information. And Stu and I talk about this all the time. That's why we make these analogies to things like card games and stuff. It's not really about guessing. It's about playing the hand that you're dealt. So with that, let's go ahead and take a look at how this is going to play out. And as always, before we continue, for anyone who'd like to get more information on this, please visit us at marketrebellion.com/get started. We've got lots of great information, free videos, a lot of things to help you get started so that you can jump in on the options arena here with the rest of us. Super, super important for these volatile markets. So the thing that we want to show everybody today, Stu, is that call options are insurance. And that might take some of the new traders by surprise because they usually hear of put options as insurance. That makes sense. We buy shares of stock. We can buy a put to insure those shares.
Hold on. Are call options supposed to get me on the train when the stock goes up? I don't understand how that's insurance.
Exactly. And some people will say, well, wait a minute. What if you short shares of stock? It's insurance. Nope. It's insurance beyond that. It's a hard thing to see. And this is why so many traders have a blind side when they're trading these calls. So the first thing, we're going to get it out of the way up front. Call options are a form of insurance. So how is that?
It helps. Let me make one statement here. So it helps to, as we go through this, everybody, it helps to think about the loss side of the equation, something that I talk about a lot. Everybody knows what's going to happen if you can be the winner, but what happens if you can be the loser? That's something that nobody really talks about. So when we're talking about insurance, we're really talking about some vehicle, some product that's going to help you not get blasted, right? Your car, your health, your flood insurance on your home, whatever kind of insurance it is, you're buying something that will help to make you whole or partially make you whole to some extent. So as we're going through this, think about if you had gone out, the relative base is like, if you had gone out and bought the stock and it went against you, what would happen? What would happen?
Right. So the way that we want to show, one way to show that it's insurance is to go back to synthetics or to put call parity. This is another reason why we like to teach this so much. We talk about it a lot in Q&A. In fact, next week in our Q&A classes, we are going to do a breakout session on synthetics and put call parity. Super important to understand for traders. So
one of the come in and it's end.
So one of the forms of put call parity says that we're going to take the stock plus the put on one side of the equation, and it will equal the call plus cash. So if we look at the left and right hand sides, we have assets on both sides. On one side, we have stock. On the other, we have cash. Cash is an asset. But we also have another piece of the puzzle right here, and that is the insurance. So yes, it's true that a call option can insure you a short stock position against upside losses, but it also insures your cash against missed market rallies. So if we're kind of trying to stay on the sidelines and we go, okay, maybe I don't want to invest, let me buy this call option, put a relatively small amount of money in there. So if the markets do take off, I can at least capture that. But if they don't, I've at least got the cash.
Relative to the amount that you would put in had you bought the stock. And that's the leverage that we talk about. That's that could be the 85 delta, 3-to-1 leverage, 4-to-1 leverage, sometimes 5-to-1 leverage. That's the money that's not on the table that you're not using, that you can use as your leverage. Go ahead, Bill.
Yep. So let's take a look at why this balances, because again, it looks kind of weird to say that stock plus put equals call plus cash. And it really gets down to a basic premise in finance that says if we have two different portfolios, you can think of these as two portfolios, stock and put in one and call and cash in another. And if they have the same values at all states of possibilities, all different stock prices, then they must cost the same. They must be the same. So here's a very simple way to look at it. We're going to put Stu on one side and me on the other. We both have $10,500 cash. Now, okay. Stu's going to buy 100 shares of stock at $100 a share, and he's also going to buy a put. So that would cost him, we're going to assume it's a $5 put. That would cost him $10,500. Yeah. So he's got no more cash. He's got stock plus put.
Now think about what I'm doing here. I'm buying the stock. Why? Because I think it's going up. And what am I doing with the put? I'm insuring it because the put gives me the right to sell that cash, or the stock. The stock represents the cash. So I'm buying the stock, and I'm also buying the right to dump it if I choose to, and it's costing me a premium, and the premium is $5. So go ahead.
Yeah. So that's something that does fit in with an insurance policy. People kind of get that analogy. Yeah. Well, let's go over here to my side. I've got 10,500 cash. I'm going to take 500 of that, and I'm going to buy the call. We're going to assume the call and the put trade for the same price. So now I'm sitting on 10,000 cash plus a call. Now watch what happens. If the stock goes down, Stu's going to exercise the put and turn it into 10,000 cash, assuming he's got a $100 put. If the stock goes down, my call option goes out worthless. I've already got the cash, but we both end up with 10,000 cash. The difference is Stu had to physically do something. In other words, had to exercise to get the 10,000 cash, but that's really irrelevant. We both end up with 10,000 cash.
Yeah, it's just
if the stock goes up, Stu ends up with stock because his put option goes out worthless. Yeah. What happens to me? I can exercise, take my 10,000 cash and convert it to stock. So now I'm the one that has to do something. I've got to pull the trigger and actually exercise. But look at what's happening. Stock goes up, we both end up with stock. Stock goes down, we both end up with cash.
Looks exactly the same to me, Bill.
They are exactly the same. They are just two different ways of doing the same thing. And that's really the whole essence behind put call parity and synthetics and what makes everything add up. So now let's take a closer look at the insurance benefits. And so we're going to look at a rare work of art here. I'm going to pretend it is. I have no idea if it is, but we're going to say that it has a $10,000 value. It can't be all that rare. And we're going to buy $10,000 worth of insurance. So we might say that it's a fully insured piece right now.
And everybody think of this, Bill's using an example of a painting, but this painting could be your stock as well. I mean, we're just using it as an example. It's just a commodity. It's just a commodity that exists, that has a value to it. And we're going to let's see what happens to the value of that commodity.
Yep. So now, fingers crossed, let's hope that the value of the painting goes up to $20,000. What happens now to this relative position of our insurance?
Well, it kind of looks like it's not enough.
It's not enough. We're starting, or at least we're taking more risk.
Yeah.
And what if the painting goes up to 30,000? If it goes up to 40,000, 50,000? If we wish to get our insurance up, what do we have to do here? Well, because we're using an insurance policy, I think most people would say, well, no kidding. You have to buy a policy or up the amount that you're insuring.
Yeah. Hey, Mr. Insurance person, can you up my policy to 50,000?
Up my policy to 50,000. And that is going to cost you money.
You mean they won't give it to me for the same money?
They're definitely not going to give it to you for the same money because we're insuring a higher dollar value.
I can't insure an Acura ILX for the same price that it's going to cost me to insure a Ferrari.
Not going to happen. So it's going to we've got this insurance here that we have to buy, or we don't have to buy, but we have to pay a premium if we want to lift it up to the.
If our goal is to ensure the full value, which we can assume we don't have to do that, but we can also assume that since we started out that way, unless we have a reason to change it, we now have to make the adjustment to make it a $50,000 policy.
Yep. So there is a cost to do this. And again, I think this is one that everybody sees when we use the analogy of insurance or put options. But now let's do the same thing with a call option. When you roll up your calls, you are increasing the level of the insurance.
Hold on one second, Bill. Can you go back one slide? All right. So as this value goes up, and we used to have that at the money put, that's the 10,000 cost. Now the value is higher, the stock price is higher. Bill's talking about rolling that, which was the at the money put, say, for example, which is now the out of the money put, up to the at the money put,
the new at the money.
That is going to cost money to do.
That will cost money.
Okay.
So it gets a little mysterious here. Again, this is the blind side when we start talking about calls. So when you roll up a call, you are increasing the level of your insurance. Now you're collecting cash. And this is what causes the misperception. People think that it's an income generating strategy or that they're just sweeping money off the table. And those are ways of looking at it. But what you're really doing is increasing the value of the insurance. The reason there's a cost is that you are losing more than the difference in those strike prices. So for example, let's say we have a $100 stock and a $100 put. We might say that this is full insurance. This is exactly the same example that we just did with the painting. So if the stock falls to if the stock is currently at 100, how would you value that? Well, again, it's just like with the painting, we would say that's full insurance. But what happens if the stock price rises? Just like with the painting, we're having to bear more risk unless we roll up that strike. So our put is out of the money, but if we had the $100 call, it's going in the money. Mm-hmm. So what's happening is that as we roll this call option, we are protecting the amount that we could potentially lose. We're protecting that cash.
Remember, which is your intrinsic value. We call it in the options world intrinsic value. It's the difference between the strikes.
Yep, and the strike and the stock price. So in my example, I had 10,000 cash, and then as that stock starts going up, I can at least capture that. But now I might lose it if I don't roll that call strike up. So take a look at this. Here's a pricing model. I'm going to assume that we have shares of stock purchased for 100. That's the black line. And we're going to buy a call option, $100 call. And what we're going to do is run it through a pricing model. Time stays the same, stock price stays the same. And every time the stock price crosses the next strike, 105, 110, 115, and so on, we're going to roll it. Now, I'm not saying that's the most efficient way to roll. I'm just trying to show what happens. And we're going to get the same relative picture either way. So here we go.
Can we do a quick sidebar right here?
Yeah.
Notice the left side of that. On the left side of where these two lines cross. That's your downside stock. That goes on forever. Actually, it goes down to zero. Yep. Stocks go to zero. Not saying your stock will go to zero, but that's your downside risk. The call can go to zero, but it's going to go to zero, at least at expiration, at the strike.
Yeah.
The difference is what you're saving. And that is why we insure the downside.
We are insuring the downside of cash. I didn't buy the stock yet, but I'm buying the call in anticipation of buying the stock.
In anticipation. And whether you do or not, that's another story. That's an exercise. But you could see that the value of the loss that didn't happen is your insurance.
That's the insurance
value. That's why you buy the call. It's like, it's kind of tangential that the stock might go up. That the call might go up with the stock price, that's like an effect of the movement. But look at what you're saving in the event that you have some catastrophic event and the stock goes down and, you take a 50% haircut on $100 stock and you lose $50. When the in the money call might have cost you 10 plus this premium of 1 or 2 and you're out $12. Yep. One, you lost 100% and the other one, you lost 50%. Well, which one are you going to take? I'm going to take the 100% because I lost $12. But you could take the 50% and lose 50, but I'll be better off. So go ahead.
Right. So now we have the 100 call. The stock goes up to 105. There's our roll. Goes up to 110. There's our roll. Goes up to 115. Goes up to 120, 25, and then at 130.
This is so notice every $5 increment.
Rolling every $5 increment. Now, notice what's happening. Over on the left-hand side, we are shifting up this baseline right here that Stu was just talking about. That's the insurance. That's going to cost you money. But people only see it as a credit, but there's a cost. You're rolling up this insurance. Look over here to the right. What's happening to the lines? They're compressing. And that's because, hey, if we knew that the stock was going up, if we had a crystal ball, why would we even buy the call option? We would take the stock. We will always have more dollars.
More dollars,
assuming 100 shares per contract.
Yeah.
We're going to be better off on the black line. The reason that we're doing is because there's a premium to pay for the insurance policy. You've got to think insurance.
Now think of this, people. Rolling every 5 points. Are you going to get $5 every time you roll a 5-point strike? Obviously, the answer is no, because there's extrinsic value. And even if there wasn't, I can tell you from 30 years of being on a floor trading options, you're not getting 5 because there's no benefit to somebody paying 5.
To paying 5.
Who's going to pay 5 for something that can't go any higher? So you're not going to get 5, and then you're going to push in extrinsic value. Maybe you get 4. Maybe you get 3.5. Maybe you get 4.25. You're not getting the 5 that you think you're rolling for, even though it looks like you're getting paid the $4 or the whatever that number.
So we can actually see that here. We would have roughly a 50 delta. I think most people know that we're rolling at the money. We're assuming the stock goes from 100 to 130. If we look at the black line, lines up right there at 30. You picked up all 30 points as a stock owner. Why are we sitting up here between 10 and 20, which is right at 15? Because we had a delta of roughly 50, and we've swept $15 off the table. 15 of the 30.
Which again is your delta.
That's our deltas. But the point that I want you to see here is that we are reducing the amount we can lose. In this case, we've actually increased it above to a point where we can't really lose, at least our principal, but it comes at a cost over here that we are compressing to the downside.
You're not making as much, but you're also taking away the ability to lose as much.
It's an insurance policy.
I'm quite sure when you look hedge up in the dictionary, it's going to say something like it's going to take away your ability to make the extra money, but it's also going to limit the ability to lose.
It's about protecting. It's just like the painting. How would you make more money by selling that painting? Well, you'd make more money had you not bought the insurance policies.
Yeah.
Insurance policies were not done to help the upside. They're done to protect the downside. And that's exactly what's happening with our call. So let's say that the $100 call is trading for 20. We roll to the 105 for 16. Here's another blind side where all of the traders make their mistakes. They go, oh, that's a $4 credit.
I don't think of it.
I'm getting $4 cash. It's an income generation. I'm sweeping cash off the table. That's why I want to roll. Yeah. Now, Stu, I'm going to put you on the spot here. How would you see this?
I don't see it as a $4 roll. I can tell you right now.
I don't either. How do you see it and why?
I see it as a $1 cost. The $4 roll, the $4 credit on the roll, that's something on my instrument cluster. That's a gauge to help me, kind of help me navigate when to roll. I don't see it as a $4 credit. I see it because I'm rolling cash for cash. 100 to 5 is $5. How does John do? $5? $5?
Yeah.
It's a $5 roll. I'm rolling from 100 to 105, yet I'm only receiving $4 for my $5 bill.
Right. You used to have the right to pay 100. Now you've got the right to pay 105. Well, that's a $5 disadvantage. We have to account for that. That's a $5 loss in your advantage in exchange for a $4 credit. So on a net basis, it is a $1 loss. Why is it a $1 cost or a loss? Because you're increasing the insurance. It's
from
not
100 to 105. See, the door to get out used to be 100.
Now it's to your advantage. We can't take losses below 105.
105.
Whereas before we would have to take losses. We could, or at least would open the door for it all the way down to 100.
Think of your elevator. What's that thing? Up the stairs, down the elevator. That's how markets work, right?
Yeah.
So think of the elevator. You're in the elevator shaft, and the stock's just going down and down. The market's getting killed. The market's going down. The stock's going down. You want to get off. You're in a 20-story building. You want to get off at the 15th floor, or you want to get off at the 10th floor, or the 5th floor, or maybe watch it go all the way to the ground. You want to get off. Get off. Right. Where's the door to get out? Would you rather have the 105 door, or would you rather have the 100 door? Well, it's going to cost you $1 to get the 105 door.
Right.
And yes, that will eat into your return. That's right.
Yes, it will.
Yeah, it's absolutely.
See, it's a very different perspective. Everybody sees this as a way to just generate cash. And that's why they usually roll way too often. Oh, I collected a 75-cent credit. Oh, I rolled again for $1.15. I rolled again for $1. Well, that's basically saying that you're paying $4 insurance policies roughly to increase the level of that insurance. They're just synthetic sales. They're doing nothing for your returns. You're exiting the position, nearly guaranteeing a loss.
Rolling for 75 cents on a $5 roll is not really going to change your delta all that much.
It just isn't. No.
Right.
So again, little plug for anybody who's new and likes this kind of stuff. It is absolutely essential to your success. Please visit marketrebellion.com/get started. All right. So Stu, up to this point, so far, we've talked about, hopefully hammered into their heads, that buying a call is a form of insurance in exactly the same way as it is for buying a put. Mm-hmm. So what we really want to close with, though, is why does this matter? Why is it important? Well, a mistake that traders make is that they assume what they know is more important than what they don't know. We've talked about this recently. Risk is what? What's left over when you think you've thought of everything?
What you don't know. I assume I know nothing. That's
right.
Where I come from.
From the trading perspective, that's the best way to say there's a lot of stuff that could happen.
I know nothing.
How do traders handle it? Here's a stock on, or a chart on Apple, and we can see there's lots of fluctuations around there. But if we connect the lows to the highs, there are areas that are below average. Let's say that's kind of the average growth rate, and areas above. If we want to buy low, sell high, we should be buying down in these regions. We should be selling up in these regions. But think about how traders look at this. They'll say, oh, look what the stock is doing. It's running. Let's go buy calls. Well, I just talked about this today in Q&A. You don't want to think this is what it's doing. It's what it has done. A very big difference.
You're looking at what it has done.
It's in the past. And this is where people want to get in. So where are they getting in? After the stock has gone up. That's the only way you can identify an uptrend.
So you're making an assumption that the stock is going to keep going up.
It's going to keep going.
And when you start pricing it, when you start putting into this idea of pricing distribution and standard deviations, all that kind of groovy stuff, it's like the higher it goes, the more behind the 8 ball you are.
That's right. And that's when everybody wants to get in on the call options. And then when it goes down, when they should be buying, what do? Oh, look what the stock is doing. It's going down. Let's go buy puts. Let's take the short side. Well, for the reasons that Stu just said, hang on a second. If it's in a downtrend, you're well below average, you are far more likely to be in buy territory. And people are wanting to do their sells there. They're selling low and buying high.
Now, keep in mind,
we have to get out of this mindset of that we want to watch for a big trend to develop, which means we've missed it, and then assuming it's going to continue and jump on and buy calls.
This is big picture. This is not
very big picture.
Happen in the next 5 minutes. This
right,
is
right. This is big
long
picture stuff.
Periods of time. This is investing.
Right. So watch what happens here. Let's take a different perspective. Let's go back to what we saw. We both have 10,500 cash. Stu buys stock plus put, and I keep the 10,000 cash. I spend 500 on the call. Stock goes down. Stu exercises and gets his 10,000 cash. What do most traders do? Oh, man, bummer. My call option expired, worthless. I'm never going to touch those stupid call options again.
I lost 100%.
I lost 100%. It's exactly what you did in our first example.
Is a scam. I lost 100%. This is a scam.
Right. It's exactly what we tried to show in the example when you had to guess the card. You guess the card and go, oh, wow, I failed on the guess, so let's just walk away.
Even though I got two tens in front of me.
And then you said, well, hold on a second. We're playing blackjack. Why don't we play the cards we've been dealt?
Play the hand.
So what I'm going to do is going to say, okay, yes, my call option expired worthless, but that's my insurance policy. So what does that tell me? I bought it to insure the cash in case of a market rally. Well, obviously there wasn't a market rally. What do we know? What do we know today that we didn't know then, just like with the horse race?
That the stock is down.
Stock must be down. That's the only answer there is. What can I do? Play the hand that you have. Buy the shares.
Buy the shares or buy another call.
Or buy another call. This is why I talk about averaging in. It's your moment to buy.
Look at all the money you saved by not buying.
Correct. What if the stock's at 80? Okay, so what? So what? Buy it at 80.
Yeah,
we lost.
Assuming that you still like the stock.
Agreed. Everything else we're assuming is the same.
You still like the stock. The story is the same. You still like it. It just happens to be, 80 instead of 100 now. Is it? Right. Ron used to talk about this all the time. Is it the stock that's broken, or is it market forces that are creating a lower stock price?
Very good point. So now if the stock goes up, Stu says, all right, my put option expires worthless. My insurance policy expires worthless, and I'm still holding the same old shares of stock. What can I do with the call? I'm going to roll it or potentially just sell it and convert it to cash. See, notice that we're now on the diagonals, whereas before we were doing the same thing. When Stu is getting stock at the top, I'm taking the stock at the bottom. And when he's getting cash at the bottom, I'm taking cash at the top. We're just taking advantage of the cards we've been dealt. Right. And that is probably the most important thing to talk about. That's why we talk about scaling in all of the time and different strategies that are making use of these fluctuations.
React. You can react.
You have to react to the market. Markets don't go straight up. They fluctuate. So the only way that you can buy low and sell high is to wait for them to pull back. And that's when everybody else freaks out and says, I'm not touching it. I love this one, Stu. I love this one where they'll say, oh, let me wait till things recover. Well, wait a minute. So they're low right now to where you could buy the shares, and you're going to wait until we see this nice big uptrend that's now 30% into the works, and now you're going to buy when it's high. It just makes no sense. This is the time. I didn't know it at the time I bought this call that the shares would be down, but just like the horse race, now I do. I have information that I didn't know.
Yeah.
And that's one of the benefits of options. They allow us to wait and see how the future unfolds. It's one of the most powerful uses of options, and nobody uses it, especially with calls. They think it's just about speculating.
I truly believe that the reason that people don't use it is two reasons. One, because they just don't understand the product, which is where which is why we do things like we're doing right now. And two, because everybody wants to keep their eye on the percentage column.
Yep.
They want to keep their eye on the percentage column. We used to have new people that come into the floor to trade options, and they'd all be looking at they all be looking at the percentage column. We used to have they used to be DOS run programs. They weren't Windows. That's how old I am, by the way. And it was like a running joke. You couldn't change the column because you had to rewrite the code. So you had to have a piece of electrical tape to cover up the percentage column, so people didn't start thinking about like, oh my God, I'm down or up. And that doesn't mean anything. It means nothing. You're only looking at half the equation. If you truly want to use the percentage column, you have to work into the leverage side of the equation as well. And that's going to balance it out. So don't worry so much about these percentages. Worry about the numbers. Worry about the money. Follow the trail of the money.
Yep.
And that'll answer a lot of your questions.
Yep. So now let's go back to Chalk Talk. Obviously, or at least we hope, you should realize that this is a better situation to be able to place your bet rather than this.
You have knowns that you didn't have before.
You have knowns. See, the thing is, if you place your bet here, you don't know who's going to win.
Who's ahead? Who's behind?
Might think, but now when we do this, we have a lot more information. And because in the analogy of a call option, I didn't place my bet, but I locked in my price.
Who do you want to bet on now? You want to bet on the guy?
Now, do we want to exercise for that call? If not, we'll say, you know what? It's a good thing I didn't buy the stock. I can now make a more informed decision. Mm-hmm. But traders don't do that. They just walk away, say, I lost on my call, and I'm never going to touch those things again. Or let me think, oh, now I think it's going up, or now I think it's going down. You need to treat these as an insurance policy.
Here's an interesting observation. Think about if they're all lined up in the other slide, if they're all lined up even, let's just for fun, chits, poops and whatever, giggles, right? Just think about like they're all even odds. They're all even odds, right? You may have your own thoughts, but let's just say they're all even odds, right? That's the 50 delta. That's the at the money option. So now, and if they're all 50 deltas, they're assuming they're all the same time period. We're not talking about time value of money. They're all going to be priced the same. So now go to the next slide, Bill. Right. So now, do you think that the market is now going to price the guy in the right with the green hat versus the guy on the left with the red jersey.
Not even close.
Going to price this relative distance between the guy in the front and the guy in the back
based on probabilities. It's what I think the probabilities are, but there's no question this bet up here, if you could now place bets, is going to cost you more and earn you less. This guy's going to be very cheap and potentially earn you a lot. He's going to be the out of the money option.
That's the guy the out of the money, and the guy in the front is the guy that's in the money.
It's in the money. Your insurance policy is now declined because you're so deep in the money. The market has tipped its hand, and now we can say, all right, it was a good thing I bought that call. Let's exercise it.
Which is your premium. That's your insurance.
And that's what we paid for it.
Now, this is a way to explain like how and why the premium or the extrinsic value. It's not just about time. It's also about the distance where this guy is in the front or how far it's in the money. It's why that extrinsic value is going away. It's not just from time. It's also from distance.
Right. Well, we talked about that with the piece of art or the stock as it went deeper and deeper. As the price of the art went up, what happened to the value of the insurance policy? It was shrinking. We saw it as being almost worthless. Yeah. That's exactly why, as your call option goes deeper and deeper in the money, the extrinsic value, the insurance policy shrinks because, as Stu said, the distance is getting greater. And if you want to increase that insurance, you have to roll it. Everybody sees it as cash, and it's really a net debit because you're increasing the insurance policy.
Yeah.
So lots of things we can talk about here. You can tell that could go on for so long, but it's always about understanding the perspectives of what's actually happening, understanding that calls and puts are insurance products. And if they also allow you to wait to see how things unfold over time. And if you take that perspective, we think you're going to see a very big difference in your results. So that was really all we wanted to present. We hope you gained a lot as always, Stu. We're going to talk about synthetics and more about this next week in our Q&A. So if you're part of our Q&As, we'll see that. And if you're not, please call it Market Rebellion and see if you can get a spot in the Q&As.
Yes.
Any final comments on there? I think this is a good one.
I want to bet on the guy on the right.
You want to bet on the guy? You're going to pay a lot.
It's okay. I got a much bigger chance of winning.
Well, I'd have to agree with you. That's why we also tend to lean towards the in the money options. So hopefully, especially for people who are new, that will give you a very different perspective because we don't think you're going to capture that anywhere else. So I want to wish everybody a great weekend, and we'll look for you next Thursday, 4 p.m. Eastern time for our next Coach's Corner. We'll see you then.